Hello and welcome to our macro and strategy update. In this video, we'd like to focus on the reasons why we think US consumer spending is on fire. Put into context, consumer spending represents more than 2/3 of total US economic activity. The American consumer is not only important for the ongoing recovery in the US, but is also traditionally a locomotive for global growth. First, the facts. According to official data published by the Federal Reserve, US household net worth has increased by a stunning $5.2 trillion from the end of 2019 until the third quarter last year. It is in particular deposits, the highly liquid part of assets, that gained massively. In tandem to that, household savings increased strongly during the last 12 months. Indeed, the personal savings rate is now north of 20%, a big jump compared with the 7.5% recorded on average in 2019, that is to say, before the pandemic outbreak. It can be estimated that excess savings, that is to say, those savings accumulated that are above a normal trend, amounts to a total of $1.8 trillion. In short, the war chest of US households is full. Now, one main question is whether this will lead to significantly higher consumer spending or not. We believe it will. For one, past lockdowns have given rise to strong pent-up demand. Even more fiscal transfers are on the way. Also, the US is ahead of others in its vaccination program, and there are many signals that economic activity is recovering strongly. Once the economy reopens fully, there's plenty of fuel for a spending spree. Indeed, latest retail sales numbers signal that this is already happening while consumer confidence improves. Though we are not saying that the totality of those excess savings is flushing into the market and raises aggregate demand, as the fiscal multiplier of the stimulus programs, for instance, is less than 1, we do expect US personal spending to continue along a strong path. Currently, consumer spending growth in the US is expected to rise 5.7% this year, according to consensus numbers. We are more optimistic. As to investment implications, we are favoring equity investments in the hotels, restaurants and leisure sectors, as well as in airlines. Those segments in the US, but also more globally, will benefit from this pent-up consumer demand and are in pole position to gain as economies are fully reopening. Thank you for your attention and see you next week.